Welcome back. This is Business. My name is Simba Elijah Charles Kiage. Good. Just before we went on break, we're talking about BAT's fight to have the nicotine pouches classified under the Nicotine Act. Gabriel, which therefore begs the question, if they're not going to get that classification, it would just be a matter of volume, because they will be doing the same business that they're doing right now. Is there a need for them to continue investing in this 3.74 billion manufacturing plant that they want to set up in the country?
I don't think it really affects their plans as far as the plant goes, because remember, BAT, if you've been to their factory, they produce about 10,000 cigarettes every minute, if I'm not wrong. What is most interesting is that a lot of even the products for the African market are actually manufactured in their plant here. Why? I'm not really sure, because I mean the taxes here are not the friendliest. But it's always more efficient for such an operation to have one manufacturing plant. I think it might be related maybe to the raw material. But what happens is Egyptian products are actually manufactured here in Kenya. Egypt, as you can imagine, is one of the biggest consumers of tobacco because of their population, too, because, those guys smoke every time. You could be in a meeting, a proper solid meeting as we are, and the guy just pulls out a cigarette. Everybody else follows through. You walk in the corridors in the office, they're just smoking in the corridors, no ventilation. So you can imagine if products for such markets are actually developed here. If you go to their plant, you see even flavored cigarettes which are not marketed here, being produced here. So I don't think it affects their factory plans. It will affect the revenues of the local one, the local entity, although the factory, of course, will charge a production fee to the other markets, etc. But it does not affect the factory plans. Because the factory does not only produce for the Kenyan market. I mean, if Lyft is facing a struggle here, they will still produce Lyft for any other market that they're really looking to sell to. So it doesn't affect their production plans. I think in terms of performance, we've seen BAT has been growing, almost consistently. But I think now the problem is that Lyft was actually one of their top 4 pillars. If you look at their previous report, it was actually at the top of, the products that they were actually talking about in terms of growing their portfolio, because previously they've grown their portfolio through flavor, not really a fresh oil product. They've actually grown through flavor and all of that. So Lyft was actually what was getting them away from them. The hard marketing. If you look at the product, it's nice, it's a pouch, nice colors, etc. So I mean, the regulation, and I think they're ready for it. Not even I think, I'm sure they were ready for the fight with regulators. So I think the Kenyan market, because I've not seen what is happening in other markets as far as regulation goes, might be a testing ground as far as regulation goes. They figure out how to deal with the Kenyan market, then they find it elsewhere. But BAT is ready for this fight with regulators. They know they have markets, Ethiopian, Egyptian, and just the Maghreb region at the top. They will not be given problems with the regulation. So even if it doesn't pick in the Kenyan market, they will export the product. Simple as that for them.
Homingari, do you share the same sentiment that Gabriel has this morning? Well, that despite whatever sort of regulation or classification that the Ministry of Health is going to give the nicotine pouches, well, it will be like they will move on with it. But you share the same sentiment, because if you're going to come up with a different product line that is going to be classified as the same line that you actually think is getting hit by a lot of same tax, then why would you get into it?
Just 2 things to say. I agree with Gabriel on what he said, but 2 things to add. BAT is an expert in lobbying. And we can't rule out that they actually know where the buttons are.
Looks as if they're losing it, because, well, they lost it to the CS again this year after they looked like they won it last year.
Yeah, but it's long term, it's not short term. So they can lose today they can lose the battle, but not the war, you know. And they're very strong in lobbying. They got a lot of resources to that. So it may be reclassified in days to come if it is that important to them, and if it's going to affect their revenues that big. So trust, they have deep pockets for the lobbying world. And in this country, you know, it's the politicians we lobby, and that's not very difficult to do. Now, on the other side, just like Gabriel said, this is a global company.
Yes.
The purchases are not a new product. And I'm sure from the research, they must have seen it's marketable. And so being a global company, they're not doing their plans, their factory plans, just looking at this micro market. They must be looking at the whole market that they distribute. And maybe because of factors of production, that's why the factory is here and they are investing in it. But they can actually be able to distribute this product to all the other markets, so that even if it is not marketed here within the country, they can actually use this just as a production zone, and it's going to be available elsewhere in the market. And then they got big markets, just like Gabriel said. The Maghreb is very, very big. And then as lifestyle changes, even as though we try to fight with tobacco and tobacco products, there's always going to be that new generation that's going to take up something. And I'm sure they're looking at generational changes and how they can get people to make these lifestyle choices. So they must have looked long term, so they are not likely to be affected for long by what the classification is here in the country.
Pretty much. All right, let's move on to the last issue that we have for you this morning. And that means that we have to look at the Cooperative Bank of Kenya, again, which has reported a profit before tax of 14.3 billion shillings for the financial year ended 2020, a 23% drop compared to 14.3 billion shillings recorded in 2019, attributing the drop to increased loan provisions as a result of the pandemic and absorption of currency translation losses in its southern Sudan operations. Now, loan provisions for the bank jumped up 235% to 8.5 billion shillings from a 2.54 billion in 2019, denoting the effect of the pandemic on the lender's operations in 2020. Now, the bank saw total assets growing by 80 billion shillings to 537 billion shillings compared to 457 billion shillings in the year, which was an 18% growth, with net loans and advances book growing 13.8% to 378.6 billion shillings from 332.8 billion shillings. Fantastic. That is their performance. So, Gabriel, as expected, but the question we should be asking this morning, Gabriel, is that, well, what do you make of core bank's performance in the wake of the coronavirus pandemic? And is this a true reflection of the banking industry performance within the COVID-19 pandemic? And if so, then what is going to happen to the lower tier banks in the country as we wait for them to give us their results before the March ends?
So yeah, I think this has really gone as expected.
Yes.
You know, we expected banks to obviously continue to increase their provisions. And I think I've mentioned to you previously, Gary is not happy. They do get a lot of money from banks, and they have intentionally asked banks not to increase their provisions, which is very imprudent in the past. But yeah, so yeah, I mean, banks, one, we have to agree that genuinely their portfolios have been hit.
Yes.
We have very many assets that have gone bust. Some really have to go into 2 years restructures. We've just seen KCB saying they're going to go into another 1 year of moratoriums and extensions beyond what CBK had allowed. KCB is a market leader. We expect the same to follow through for these guys.
Yes.
Because that's the only way they can be able to accommodate some of their customers, because ideally if a customer fails to pay interest, you're supposed to declare that loan as non-performing, and that has an impact on your balance sheet, and no bank wants to report a decrease in balance sheet size. Now, in terms of profitability, it's expected. I think the bank, other than the questions we have on their assets, we can see they continue to generate income. Their income grew. Their cost of funds has not changed. In fact, they paid very little even with increased deposits, they paid very little interest to consumers.
Yes.
And that's very unfortunate. But yeah, the provisions, I think it's something we need to look at, because all these, I refuse to believe could have happened in 1 year. And I think I've kept telling you that they have been carrying bad assets that they have been negotiating with through and through. And then when COVID came, they decided, you know what, anything that is bad, we'll deal with it this year. So they just declared. Now the problem is, of course, you cannot take it all out of your balance sheet in 1 year. Otherwise, you're going to hit your shareholder funds significantly. And banks are valued based on book value. So this has a direct impact on their valuations, which is very key, of course, for the shareholders. Now, what these banks have to do is find a new business. Now, that is very hard in this market, given where businesses are performing. Anybody who's looking to switch banks probably is bad. You know, it's not the best customer you want. So that's really the problem they're facing. Now, on your question on how this affects smaller banks, any good customer with smaller banks is actually now going to be called upon by these bigger banks. Why don't you come? We'll provide you with this. You know, anyway, if you're banking with a smaller bank, these people actually use the bigger banks as their collecting agents. They have a bank account with the bigger banks that they use to collect their revenues, because a small bank does not have a branch in Busia, a branch in Isiolo, a branch in Makueni. So they use the bigger banks. So the bigger banks are actually looking at the people who only use them as collecting agents and then trying to bring them up. So smaller banks might lose their sweet portfolios. Fortunately for smaller banks, they have actually more controls. So they do not allow anyone go into default or allow many of their customers to be those shaky businesses. If you're a shaky business, you don't get a loan from a small bank. It's very hard. They only take the best of the best, because if you know what has been happening previously, the smaller banks are not able to charge high interest rates. So they are actually the ones with some of the best customers at this point in time. What's the converse of that? If they had a good customer who was a hotel or one of the businesses that has been hit bad, then one customer could actually result in a big loss in their portfolios and in their performance. So for small banks, we'll see a mix. You'll see some that will actually remain as they were before. You'll see others that might actually do better. And you will see, I want to bet at least half of them will actually suffer more than the rest. That is actually what is going to happen, because, you know, if for COP to have this level of provisions, we're talking about hundreds, if not thousands of customers suffering. But for a small bank, it could even just be 2 customers, each with, let's say even $500 million. If you have 12 billion balance sheet and 2 of your customers who you've loaned to 500 million suffer, you're in problems. But we're going to see a lot of hunting for customers across banks, stealing from each other the customers. That is what is happening, because there's no new magical business coming in. Expansion is slowed down. That's a problem. And of course, they're still running to the government to lend to T-bills and bonds.
Mr. Homengari, well, Gabriel is saying we do expect to have sort of what is not predetermined performance for the smaller banks within the economy. But what would your prediction be really for the performance of the banking industry in 2021? Because we're still right within the grips of the coronavirus pandemic, and you have banks like Equity Bank that have actually extended 3-year additional moratoriums to some of the customers who think they're going to still be affected by the coronavirus pandemic. Where do we find ourselves now within the banking industry in 2021?
Banking operates in the environment, the economy we are looking at.
Yes.
We can see what the third wave is doing and the effect it's having. We have a lot of uncertainty.
Yes.
But at the same time, we have seen them take some measures that are helpful.
Yes.
I think they are cutting costs in a big way. We've seen them let space in some of the places. They've convinced most of us to do our banking using technology so that they can be able to cut on a lot of things. So yes, we'll see more movement towards using technology. Yeah, in terms of working with their clients and making provisions, that's going to be continuing and might even be much longer, because if you look at the hospitality industry, if the hotel industry were your clients, and you can see what has happened and the growth, the turnaround is not coming through tomorrow. So that's going to remain a challenge. They will cut the loss. Obviously, there's some debts that are going to be declared bad debt. And maybe this might be the time the governor of central bank has always been looking for. A couple of mergers. Maybe the bigger boys might turn and buy the smaller guys.
Yes.
And because I know there's been a movement to try and get a fewer number of banking institutions in this country so that they can actually be able to grow into muscles. So then this might be that time. It might have presented that opportunity for the bigger boys to snap up some of the smaller banks so that then the numbers get smaller and people get economies of scale to reach out to the clients. In terms of, are there going to be new customers? Obviously, we got new people coming of age, but that's not really going to create a big market out there. Yes. And that's why consolidation becomes important, so that now we can go hunting, looking at, can we do something else in the region? Because maybe we've done all there is to be done here.
Now, Gabriel, clear for us this conversation this morning. Now, the biggest announcement that a COP made when they're giving us these results is that they are going to contract a global, let me just take that again, consulting firm for an end-to-end risk management framework, which will review credit appetite, credit scoring, risk management, and pricing of facilities. Somebody's going to ask you, Gabriel, how have this changed within the COVID-19 pandemic to the point that, well, COP thinks that they need to be relooked again within this pandemic? 2 minutes, if you may.
So what this really is about pricing.
Yes.
Yeah. Because remember, you have bad customers who you are not able to overcharge.
Yes.
You know, because I'm giving you too much time. I'm giving you space not to pay me. I'm giving you flexibility. So what am I getting in return for that? You know, I'm here reporting bad numbers. Simba and Gabriel are not saying good things about me. You know, but I'm unable to punish you for that, or rather charge you for that, because I cannot price the risk in. So really bringing the consultant is so that they can work to CBK with a report.
Yes.
And tell CBK, this is our method, this is our formula. So yes, we are, based on this, the recommendation is that we are repricing for this level of customers. If you're in this cadre, this is it. If you're immediately in this rank, this is it. If you're a new customer, we do not know how to rank you, this is how much we charge you. If you're a good customer, never been late, this is how much we charge you. So really, it's bringing in the consultant so that they have a document on which they can form the basis to reprice their product, because that's the only way they're going to generate more profit from their portfolio. How it affects performance, obviously it's going to be negative for anybody who's already struggling.
Yes.
Because then I'm struggling, but then now the rate goes higher. Someone would argue that's correct, because you're struggling, ideally you would be charged higher. But then that's not what you need, because you need some time to breathe. But you know, so it's going to be a mix of situations with some of their customers. Unfortunately, the customers will have nowhere to run, because across the market, all the banks will be looking to increase the rates. So, you know, we are going to have to see some liquidation, not by the banks.
Yes.
Some customers might have to sell some non-performing assets to save their performing businesses. So really, it's still an evolving situation, even 1 year on with COVID, and COVID is not going anywhere. It looks like we're going to be stuck in the same cycle for another maybe 12 months, who knows. So again, we are not at the end of this. At the end of this, we are going to keep talking about it as the situation changes, and it will keep changing.
Pretty much. Gabriel Mwendwa and Bohome Gary, thank you very much for taking your time to speak to us here on a Metropole TV's Business AM this Monday. And that's exactly how we come to the end of our show this morning. My name is Simba Elijah Charles Kiage. Thank you very much for watching. Good morning.